Hello, I'm Tammy Green, and this is your Week in Forex from MaxiForex. Today, we will review last week's market highlights with financial analyst Martin Smith. Risk aversion is being seen in the markets again this week as fears over Greece's debt default have pushed more and more investors to safer currencies. The yen, in turn, has made strides against other riskier currencies. Ben Bernanke made an important announcement concerning the interest rate in America as the U.S. continues to attempt to climb out of this recession. Greece faces new problems as an impending credit rating decrease appears inevitable. Portugal and Spain appear to be going the same way as Greece as Europe struggles to deal with default issues. In Canada, the BOC governor also made some surprising decisions. Let's now welcome Martin Smith to discuss these and other issues prevalent in the Forex market this week. Welcome, Martin.
Thanks, Tammy.
We've seen risk aversion creep back into the market this week. Could you tell us a little bit about this?
Sure. This week we saw the yen climb to a one-year high against the euro as investors sought the safest currencies amid concern over Greece's credit rating. Now, this is, of course, a prime example of risk aversion. The yen advanced against all 16 of its major counterparts after Standard & Poor's and Moody's Investors Service said Greece face further downgrades as early as next month. Risk aversion is clearly seen as the demand for the yen is driven by the concern over the rising risk of more defaults in the European Union.
We would have seen more movement toward the USD, but an announcement by Ben Bernanke seemed to have impacted this.
Right. Fed Reserve Chairman Ben Bernanke said the US economy's recovery is still in an emerging state, and it still requires low interest rates to encourage demand by consumers and businesses once the federal stimulus expires. Bernanke kept the interest rates low for an extended time. He believes that the FOMC must continue to anticipate economic conditions, including low rates of resource utilization, subdued inflation trends, and stable inflation expectations.
What do we know about the overall economic recovery in the United States?
Well, even though there are a few positive signs for the US recovery, such as fewer job losses and a rise in manufacturing employment and stronger demand for temporary help, the job market in the US still remains quite weak, with the unemployment rate close to 10% and new job openings few and far between. The Fed will also at some point need to begin to tighten monetary conditions to prevent inflationary pressures. However, the US economy grew at the annual pace of 5.7% in the last quarter of 2009. Now, that's the fastest in 6 years. Many officials are forecasting a sustainable recovery over the coming year.
You mentioned before a little bit about Greece's debt problems, which has been an ongoing theme. What is the probability of a Greek credit rating cut?
Well, concerns rising about the risks of a Greek default. And this was reflected in the price of the country's credit default swaps, which rose by about 1/10 of a percentage point last Thursday morning. Now, this report was released after major credit agencies warned that Greek debt could be downgraded to almost junk bond status as early as next month if the country doesn't adhere to its deficit reduction plans. Unfortunately for Greece, there appears to be little, if no indication that other EU countries are prepared to aid Greece at this stage in the game. So the question remains as to whether Greece can truly service its tremendous debt issues.
Are any other European Union countries also at risk for debt default?
Yes. There's much discussion currently about the state of Spain, Portugal, and even Ireland. Time will tell, but I believe we'll see these countries in the news as time goes on.
What is going on with Canada? Many believe there would be an increase in the interest rate. What happened?
Well, Mark Carney, the Bank of Canada governor, put some of these expectations to bed since it became clear that he will be less aggressive in raising borrowing costs than was originally surmised. Now, these declining expectations for interest rates increases may suggest that Canada's short-term bonds could close the gap in yields with their counterparts in the US.
Could you share with us some technicals that we should keep our eyes on this coming week?
Sure. The US dollar might trade in the upcoming few weeks in a somewhat wide correction within a specific range before renewing the bullish momentum in the long term. The euro dollar, for example, has a bottom in the short term close to 134 and a top near 137. We may see a movement within this range before it breaks the bottom to the downside. The main target for the euro-dollar that was discussed with John Gibbons in the beginning of the month, which is 130, has gotten closer to this target. And the euro-dollar is still trading in a falling channel formation, which is considered as a very bearish formation. Basically, the euro-dollar should stay below 138.50 in order to keep this momentum.
Is the correlation between the Aussie and gold still strong?
Yeah, the Australian dollar is a commodity-linked currency. Now this means that the correlation will always be strong, especially when the correlation between the Aussie and the stock market is about 0.94%, which is very strong. The commodities are based on demand and inflation expectations. The high interest rate in Australia is supporting this correlation, and if we inspect the Aussie and gold charts separately, we'll see that since the last top, both have failed to record a higher price. The trend has become bearish. The weakness is shown by the diversion that shows lower highs and lower lows, and a breaking of a major upside trend line.
Thank you, Martin, for joining us this week. Be sure to visit us at maxiforex.ru.